Welcome to the Finding Financial Freedom podcast with the Frugal Physician, where Dr. Disha Spath will be your companion on this exciting financial adventure. Get ready to conquer debt, build wealth, and embrace a mindful spending lifestyle that will empower you to live life on your own terms.
Hello, and welcome to Finding Financial Freedom with the Frugal Physician, the podcast where we dive into the world of all things money. Today, we'll be talking about real estate investing and creating sustainable income streams through rentals. I'm Dr. Disha Spath, your guide to navigating the ins and outs of financial freedom so you can make your ideal life a reality. I'm a first-generation immigrant, and I used to live in a lot of rentals with my mom. We rented a lot of different places from a lot of different people. And now that I'm a physician and in the position to buy real estate, I feel really passionate about providing stable and clean and good housing for other people that may or may not want to or be able to purchase a property on their own. So I think real estate investing really vibes with my value set, and I take real pride in being able to provide good housing for other people. So today we're going to talk about how to invest in residential real estate through direct ownership. If you're thinking of buying a property to rent out, this episode will give you the tools to make sure it's a sound investment. We'll cover everything from the benefits of investing in real estate via direct ownership, financial analysis, neighborhood research, tenant demand, and much more. We're also going to talk about why real estate is one of the best investments you can make. Cash flow, leverage, inflation protection all make real estate a powerful tool for wealth building. Of course, we don't want to get into a property that's going to be a money sink. So that's why we run the numbers really carefully, and we'll go through all of that today. But first, the benefits of real estate investing. Let's dig into the major benefits of investing in real estate long term and why investors view it as a cornerstone of wealth building. Some major advantages stand out: cash flow, appreciation, the ability to use leverage, and protection against inflation. One of the most appealing aspects of rental real estate is the monthly cash flow it generates. As long as your rental income exceeds your operating expenses, you're putting extra money in your pocket every month. This cash flow can help you build wealth passively while your tenants effectively pay off your mortgage. Over time, as rents increase and you pay off your mortgage, your cash flow grows, creating an even larger income stream. Leverage is another key benefit of real estate. Unlike other investments like stocks, you can finance a large portion of your real estate purchase with borrowed money through a mortgage, allowing you to control an expensive asset with a relatively small amount of cash. For example, with a 20% down payment on a $200,000 property, you're controlling a $200,000 asset with only $40,000 of your own money. As your property appreciates, the gains are based on the full property value, not just the amount you invested. This magnifies your returns, assuming the property value increases. Let's talk about appreciation, which is one of the key ways real estate investors build wealth over time. There are two types of appreciation to keep in mind: natural appreciation and forced appreciation. Natural appreciation occurs when the market value of your property increases over time due to external factors like economic growth, inflation, or increased demand in the area. For example, if a new shopping center, school, or corporate headquarters opens nearby, property values might increase because more people want to live in the area. Historically, real estate tends to appreciate over the long term, though this depends on the health of the local economy, job growth, and overall demand for housing. While you can't directly control natural appreciation, buying in areas with good economic prospects, population growth, and limited housing can maximize your chances of benefiting from it. Forced appreciation, on the other hand, happens when you, the property owner, take specific actions to increase the value of the property. This could be through renovations, adding new features, or improving the property's overall condition. Examples of forced appreciation include updating kitchens and bathrooms, adding extra bedrooms, improving curb appeal, or even converting unused spaces like basements into livable areas. By doing these upgrades, you can justify higher rents, or sell the property for a higher price down the line. The key with forced depreciation is that you have direct control over how it happens. It requires investment, but if done right, the returns can far outweigh the costs. Both natural and forced appreciation contribute to long-term wealth building in real estate. Natural appreciation relies on the overall market, while forced appreciation gives you the power to drive value increases through strategic improvements. Real estate can also act as a hedge against inflation. As the cost of living increases, so do home values and rental prices. While inflation may erode the value of cash or fixed income investments, it typically works in favor of real estate owners because property values and rents tend to rise in an inflationary environment. You've seen that here through COVID. At the same time, your mortgage payments stay the same if you've locked in a fixed rate loan, that is, meaning you're paying off your debt with money that's worth less as inflation increases. This dynamic gives you the advantage of growing your net worth while protecting against the eroding effects of inflation. The combination of these benefits, steady cash flow, the use of leverage, and inflation protection, makes real estate one of the most powerful vehicles for long-term wealth creation. Now let's move on to another significant advantage of real estate investing. That's tax benefits. One of the biggest advantages of investing in rental properties is the tax benefits. Long-term real estate investors can leverage several deductions and strategies to significantly lower their taxable income. This is because the US government incentivizes creating housing for others. They want you to do this so that other people have places to live. So the US government gives us tax incentives to make it more profitable for us to invest in real estate. This is a unique incentive built into our tax code, so why not take advantage of it? Let's break down the key benefits you can enjoy. First is depreciation. Even though real estate often appreciates in value over time, the IRS allows you to depreciate the property over 27.5 years for residential rentals. This means you can deduct a portion of the property's value each year as a loss on your taxes, even though the property's market value might be increasing. Depreciation can reduce your taxable income from passive activity like rental properties, sometimes significantly. There's also another thing called bonus depreciation. Bonus depreciation allows you to accelerate depreciation for certain property improvements, typically over a shorter period than standard depreciation. For example, things like appliances, carpet, or certain renovations can be written off more quickly in the first year. This can significantly lower your taxable income on passive activity in the year of purchase or improvement, or in the first few years, boosting your cash flow in early years of owning a property. Keep in mind that this depreciation can be recaptured when you sell the property. That's why there are a few other tax codes that can make it more advantageous, but you can use a couple of other things that we'll go over in a second to avoid those taxes. Mortgage interest deduction is another important tax advantage. The interest you pay on a mortgage for an investment property is tax deductible. Since mortgage interest is often one of your largest expenses, this deduction can be a game changer for your tax bill. As a landlord, you can also deduct various operating expenses associated with running the property. This includes property management fees, repairs, maintenance, insurance, utilities, and even marketing costs if you're advertising for new tenants. So a lot of the things that you can't deduct as a homeowner of a primary property that you're living in, you can deduct as a rental property owner. So talking about that depreciation recapture and capital gains, a 1031 exchange is an important tax strategy to be aware of. If you decide to sell your rental property, you can defer capital gains tax by using a 1031 exchange. This allows you to roll the proceeds from the sale of one property into a new similar investment property without having to pay capital gains taxes immediately. It's a great way to grow your portfolio tax deferred. Another important strategy to know about is the real estate professional status, or REPS. Real estate professional status is a powerful designation that can allow you to deduct rental property losses against your active physician income. You can't do this with real estate. So you can't write off your rental property losses against your active income if you don't have rep status, but you can if you have rep status. To qualify, you must materially participate in real estate activities, spending at least 750 hours per year working on your properties and more than half of your total working hours working in real estate. For high-income earners, this can result in substantial tax savings as long as you are careful to meet those guidelines. Even if you don't use a 1031 exchange, you can leave the properties that you own to your heirs. If you own the property your whole life and leave it to your descendants will enjoy a step up in basis to current market value upon your death. In other words, if your descendants sell the property when they inherit it, they will not have to pay those capital gains taxes that you deferred during your lifetime. These tax benefits are a big reason why real estate investing can be so lucrative. By lowering your taxable income and deferring taxes, you keep more money in your pocket, which can be reinvested into future properties or into future generations. Now let's talk about types of direct ownership. Direct ownership means you're purchasing a property outright, either for your personal portfolio or for rental income. This can be either residential, like single-family homes or multifamily homes, or commercial, like office buildings or retail spaces. It gives you full control over the property, how it's managed, when it's sold, and what upgrades to make. But with that control comes responsibility, including managing tenants, maintaining the property, and handling repairs. If you're investing in residential real estate, you can rent it out to long-term tenants, short-term tenants, or mid-term tenants. Long-term tenants are typically tenants that rent for more than 30 days at a time. There's less turnover in these situations and more reliable rental income. Short-term rentals have gained popularity thanks to Airbnb and VRBO. With short-term rentals, you can rent out your property for brief periods of time, often to vacationers or business travelers. You could be renting for days or a couple of weeks. The upside here is that short-term rentals often generate much higher returns compared to long-term leases, much higher rents, especially in tourist-heavy areas. However, short-term rentals require more active management. You'll have more frequent tenant turnover, which means you'll likely need to handle cleaning, booking, and maintenance more often. Keep in mind local regulations may limit your ability to rent short term, so just check with the laws in your area and other laws that could be brewing in your area. If managed correctly, short-term investments can yield fantastic cash flow, but they demand a higher level of engagement and carry more risk in terms of occupancy fluctuations. If you're interested in short-term rentals, you may also want to look into the short-term rental loophole as far as deducting your passive losses against your active income. Finally, there is the midterm rental strategy. This approach sits between short-term and long-term rentals, and it's becoming increasingly popular among investors who want a steady cash flow without the hassle of frequent turnover. Midterm rentals typically cater to traveling professionals like medical staff, remote workers, or corporate employees who need housing for several months but less than a year. These properties often offer furnished units and flexible lease terms, making them ideal for tenants who need a place to stay temporarily but don't want the expense of a short-term rental. The benefits of midterm investing include lower turnover than short-term rentals, reducing your workload while still offering higher rental income compared to traditional long-term leases. This approach can be especially lucrative in areas with transient populations, like near hospitals, corporate offices, or universities. The key is to position your property to meet the specific needs of midterm tenants, offering convenience and flexibility without sacrificing quality. Finally, remember investing in rentals doesn't have to mean unclogging toilets in the middle of the night. You can choose how involved you want to be in that. If you don't want to be involved at all, you can hire a full service management company to take care of all the properties for you. That's what I do, and I usually only hear from my manager once a month, and that's a maximum when they give me the rundown of income and expenses. Or you can hire a contractor to be on call for you if you want to self manage. Rental property investing can be anything you need it to be. Now, let's say you've decided real estate is right for you. Let's talk about investment strategy. It's crucial to understand your personal financial goals before diving into any real estate purchase. Are you aiming for monthly cash flow to supplement your income? Or is your strategy to hold on to the property long term, building equity through appreciation and paying down the mortgage? Your strategy will guide every decision, from what kind of property you buy and where you buy it. If you're looking for cash flow, you need a property that generates consistent rental income, ideally well above your expenses. This means focusing on high rent areas, but also balancing that with affordable purchase prices. If appreciation is your focus, you might be willing to accept a smaller cash flow in exchange for expected increase in the property's value over time. Properties in rapidly developing or gentrifying areas often fit this mold. Also, big cities like New York City are more places where you invest for appreciation rather than cash flow, because usually cash flow is pretty slim due to high taxes and other expenses. You generally want to invest in properties that at least have some positive cash flow. Investing in a property with negative cash flow is very risky and is a good way to get into a bad situation. So make sure your cash flow is positive, even if it is just $100. Now let's get into the numbers. To make an informed decision about whether a rental property is worth your time and money, you'll need to understand some basic numbers. Here are the top ones to focus on. First, cash flow. I've mentioned that a couple of times, but what is it exactly? Cash flow is simply the amount of money left over after you've paid all your expenses. These expenses include mortgage, insurance, property taxes, repairs, vacancies, management fees. A good rule of thumb is the 50% rule, which assumes that 50% of your rental income will go towards operating expenses, excluding the mortgage. After factoring in the mortgage, what's left is your monthly cash flow. Now, the 50% rule is a good screening tool, but before buying a property, you must try to get very accurate numbers and an accurate picture of all your income and expense categories. How can you do that? Well, you can talk to the utility providers and get a quote. You can talk to your insurance company, get a quote. You want to get the numbers as accurate as possible so you know your investment is a good one. Another quick screening tool is the rent to price ratio. This ratio helps determine if the rental income is worth the purchase price. The 1% rule is a common guideline, meaning that your monthly rent should be at least 1% of the property's purchase price. For example, if you're buying a property for $200,000, you want it to rent for at least $2,000 per month. Again, this is a screening tool when looking at properties and looking at multiple properties. So while you're scrolling through the MLS, you have an idea of which properties you should be spending time running the real numbers on and which properties really don't meet the mark. So this is not a hard and fast rule, it's just a screening tool. And now let's get to the hard and fast numbers, the numbers that you really want to look at. First is the cap rate. The cap rate is a great tool for comparing different properties. It's calculated by taking the property's net operating income and dividing it by the purchase price. The net operating income is the yearly income minus the expenses, but excluding the mortgage costs. So the formula looks like cap rate equals NOI over the purchase price times 100. A good cap rate depends on the market, but typically investors look for a cap rate between 5 to 10%, and they use it to compare different properties to determine which property might be best. Another number to look at is the ROI, or the return on investment. ROI measures how much profit or loss you make relative to the amount of money you've invested. You can calculate it annually by taking your net income after all the expenses and dividing it by the total cash you've invested, which includes your down payment and costs. A similar number is the cash on cash return. The cash on cash return measures the percentage of cash you're earning on your actual cash investment in a property based on the cash flow it generates every year. It's a great way to quickly see how much return you're getting for the money you're putting into the deal. Here's a quick way to think about it. Cash on cash return is calculated by dividing your annual pre-tax cash flow from the property by the total cash you've invested. So it focuses only on your out-of-pocket cash investments, things like your down payment, closing costs, and any initial repairs. But it doesn't account for the full value of the property. In short, it shows you how hard your investment cash is working for you on an annual basis. Unlike metrics like ROI, which factor in property appreciation and long-term gains, cash on cash return focuses specifically on your cash flow, and it helps you understand how much income you're generating from your cash that you're putting into the property. 8 to 12% is often considered a good cash-on-cash return for a long-term rental property. If you're hitting numbers in this range, it generally indicates a solid return on your investment. Finally, another calculation I like to make using the free rental property calculator on calculator.net is IRR. IRR stands for Internal Rate of Return. Simply put, IRR is the annual rate of growth your investment is expected to generate over time. It's a percentage that tells you how profitable your investment is likely to be on an annual basis. In other words, the higher the IRR, the better potential return on your investment. The reason why IRR is so useful is that it takes into account the timing of cash flows. In real estate, this means it considers not only your rental income, but also things like when you sell the property, the timing of expenses, and even major repairs or improvements. It's a much more comprehensive way to evaluate a rental property than just looking at monthly cash flow or appreciation in isolation. Now, IRR is a bit more complex to calculate than metrics like cap rate because it involves projecting all of your future cash flows from the property and finding the discount rate that makes the net present value, or NPV, of those cash flows equal to zero. Don't worry, we won't get into that math just yet, but that's just a general idea. So, how do you calculate the IRR? I'll give you a simplified explanation that focuses on the key concepts. The good news is that there is a free online calculator that will make it super easy for you. First step is to map out all the cash flows associated with your rentals. This includes the initial investment, usually the down payment and the closing costs, ongoing cash flows such as rental income minus expenses like mortgage payments, repairs, property taxes, and management fees, and future cash flows like lump sum if you sell the property in 5 or 10 years. This includes any appreciation or proceeds after paying off your mortgage. You just plug these numbers in to the free calculator and it spits out an IRR for you. For example, if your IRR is 12%, it means your investment is expected to grow by 12% every year when considering both your cash flows and appreciation. The higher the IRR, the more attractive the investment. Knowing these metrics helps you avoid costly mistakes and ensures your investment property aligns with your financial goals. Now let's talk about other factors to consider when looking for rental properties, other than the numbers. Let's talk about what may be the most important factor: location. When analyzing a property for long-term rentals, choosing the right neighborhood can make or break your investment. Number one, economic stability. Look for areas with job growth, a strong local economy, and major employers. These factors attract tenants and ensure there's demand for rental properties. Cities with a diverse economy, not reliant on one industry, tend to be safer bets. Look for population growth. Areas with increasing population growth typically mean higher demand for rentals. Check the data for any migration patterns or city expansions. Where are people moving and why? Look at crime rates in school districts. A safe neighborhood and a good school district will naturally attract more renters. Properties in these areas tend to have a higher occupancy rate and may command premium rents. Amenities and transportation. Access to public transport, shopping centers, parks, and entertainment options are huge selling points. Tenants want convenience, so if your property is close to these amenities, it's a big bonus. Know your tenants and rental demand. When you're buying a rental property, always consider your potential tenants. Who are they and what would they want? Is the area attracting families, young professionals, students, or retirees? Each group has different needs, so tailor your property to match what they want. Families might want larger homes with yards and good schools, while young professionals often prefer apartments and condos near the city center. Look at vacancy rates. Research the local vacancy rates. A high vacancy rate may indicate that there's low demand for rentals or too much competition, which can affect your ability to find tenants quickly. Look at rent trends. Are rents rising or falling in the area? A good market will see steady rent increases year over year. You can often find this data through local property management companies or online platforms that track rental markets. Now, these are just general guidelines. There will be an exception to every rule. In fact, I've bought exceptions to these rules, but these are things to keep in mind when we're looking at rental properties. Before we wrap up, let's go over some red flags to avoid when analyzing a long-term rental property. Number one, One big mistake is overestimating rent. Be realistic about what you can charge in rent. Overestimating can lead to vacancies and missed mortgage payments. Research comparable properties to ensure your expected rent is in line with market rates. If you're working with an agent or a property management company, they can often give this information to you. Here's another thing to avoid: underestimating expenses. New investors often forget about hidden costs like major repairs, legal fees, or vacancies. Always leave room in your budget for these unexpected expenses. Don't forget CapEx. Make sure you look at big appliances and know when they're going to run out of their expected life. And make sure you're budgeting to replace those when they're needed. Another thing to avoid: ignoring future development. You may think a property looks great today, but make sure to research any future developments. A new highway or industrial project could negatively impact the area, or conversely, could really positively impact the area. So make sure you're looking at what the town has planned, looking at laws that might be passed that are being proposed right now. Do your market research. So that's a wrap for today's episode on analyzing rental properties for long-term success. Remember, investing in real estate isn't just about finding a good deal, it's about making smart, well-researched decisions that align with your long-term financial goals. And don't forget the tax benefits. Cash flow, leverage, and inflation protection alone can make real estate an excellent investment if you understand how to maximize them. If you enjoyed this episode, be sure to subscribe. And if you have any questions or suggestions for future topics, send them my way. Thanks for tuning in to Finding Financial Freedom with the Frugal Physician. Stay frugal, y'all.
The content shared on this podcast should not be taken as individualized financial advice. We are here to share our knowledge and experiences, but it is crucial to consult with professionals such as accountants, financial advisors, or attorneys who can provide personalized guidance based on your specific needs.